What is the highest personal tax rate in Alberta right now?
48% is the highest marginal rate.
I can see the whole wide world with these two eyes, and I can be whoever I want to be, 'cause it's my life.
Hi, thanks for joining us for another episode of Ask Spurrell CPA. Today we're talking about personal tax rates versus small business tax rates. Trevor, I think you've probably seen what it looks like when you own businesses and worked in businesses, and what your check looks like when the government just reaches in and grabs and takes it out.
Yeah, nothing is more painful than when I was working construction and you get that coveted overtime. And you just think, oh man, I'm going to be making so much money on this check, it's going to be ridiculous. And then you see, oh no, I just gave all that back to the government because I was employed by somebody else and not taking advantage of the tax benefits we're going to talk about today.
Yeah, so the quote that we have here on personal tax rates versus small business tax rates is a Michael Gerber quote, author of our favorite E-Myth. And the fatal assumption is if you understand the technical work of a business, that you somehow understand the business that does that technical work. And those are two separate things. And the statistic is the Fraser Institute tells us that the average Canadian pays 43% of their income in taxes. That's tax, CPP, EI, GST, fuel tax, property tax, etc. And by comparison, on average, only 37% of the remaining income goes towards basic necessities, shelter, food, and clothing. So we're spending more on tax than shelter, food, and clothing. And the story that we have here, business owners, they're not yet incorporated, and they're paying way too much tax. And even sometimes the ones who are incorporated, they're not utilizing the corporation to its highest capacity in minimizing their tax obligations. So, Trevor, what are the questions you think these business owners need to be asking?
Well, I think number one is, what is the highest personal tax rate in Alberta right now?
48% is the highest marginal rate. It wasn't too long ago that it was
awful.
Only 39%. And now, in the last few years, it's jumped from 39% of the Alberta advantage to 48%. Welcome to the new world order.
Wow. So what is active small business income?
So active small business income, this is income that's made from an active business. So it's different than income that's not passive income. So passive income would be rental income from investment in a stock portfolio, the dividend, the interest on bonds. These are passive income. But active business income is income from an active business.
Okay. So now, what tax rate is active small business income with a corporate tax level at?
So if you have active business income and you generate it in a Canadian-controlled private corporation, it's going to be taxed at 11% currently in Alberta, which is far better than the 48% marginal rate that you could be subjected to otherwise.
Holy moly. So now, do you have to be incorporated to get that tax rate?
You do. So there is no way to get that 11% tax, that small business tax rate, if you're not incorporated. You're just going to be subjected to the regular personal marginal rates up to 48% if you are not incorporated.
Wow. So how much income can you earn on an annual basis at this rate?
$500,000 a year at 11%. So it is not unusual to have a very highly paid professional, with effective tax planning, paying an all-in rate of maybe 20%. Someone who's making several hundred thousands a year, whereas the average Canadian is paying 43%, and the average Canadian is not making several $100,000 per year. So you can earn as much as $500,000 per year at 11% if you're set up the right way.
Wow. Now, how will this tax rate help someone accumulate wealth?
So someone who's otherwise paying 48% in tax, they get an extra $10,000, and that extra $10,000 is over and above what they need to live on or operate their business. That $10,000 they're going to pay $400. They're going to pay $4,800 in tax. They have $5,200 to invest. And whereas if they're incorporated, that same person on an extra $10,000 can pay $1,100 and have $8,900 to invest. You do that year after year, you're investing $8,900 instead of $5,200, and it's continually growing at that same rate of return. The person who's incorporated is just going to accumulate wealth at a significantly accelerated rate.
Wow. So now, how can a corporation even help you eliminate personal debt quicker?
So it's so extreme, the tax rate on what it's going to be personally as opposed to corporately. As I once assembled a model, I was doing a speaking engagement for a bunch of new doctors, and they'd heard the old adage of don't incorporate until you pay down all your personal debt. And I assembled the model for them. So two doctors, one who had a debt at 3%. And the debt was, I believe at the time it was $250,000, and they had so much extra income per year. And the one doctor, he paid down that debt every single year with that extra income. But of course, he had to earn that income, then pay that 48% rate. And I think in the model, I only even used 40% just to make it a little more conservative. Mm-hmm. And it took the doctor 24 years to eliminate that debt at that rate. And then I took that same professional and said, okay, I'm just going to make the minimum payments on that debt, and I'm going to save within the corporation. That same doctor would have enough money in the corporation by year 16 to take it all out and pay down the debt. So if they took it all out and paid the 48% year after year, they would never get that money working for them. They would simply be paying down the debt at 3%. It would take 24 years to eliminate the debt, and that in the same model, they were able to save at 7%, a historical rate of return on a savings. In 16 years, they could, if they wanted to, take all the money out of the corporation and eliminate the debt. So when you start looking at the tax rates that way, that even mathematically, even if your goal was to be completely debt-free, you're probably not best off taking that out each and every year and subjecting yourself to that high marginal rate.
Wow. So now, do the personal tax rates make it difficult to buy business assets?
Yeah, if you're not incorporated, a lot of people think that, I can take the assets, the profits from the business and simply buy business assets, and I'm not going to be subjected to those personal rates. Well, those are assets. They're not expenses. So you want to turn around and you want to buy a truck or a computer or an x-ray machine for your business, and you're not incorporated for that same $10,000, it's not available to buy the asset. You got to pay your 48% or somewhere up to 48%, and then that $5,200 is now available to buy that personal assets. Or that same person operating the same type of business who's incorporated, they pay their $1,100 on that extra 10, and they have $8,900 to buy bigger and better and faster equipment, and they're not going to pay as much to finance it because they're not borrowing to do it.
Wow. Do unincorporated businesses have to pay CPP in addition to tax?
Yeah, so usually the business owners, they're pretty good. They get the power of Google going, and they start looking up the tax rates. I pay this much on the first $50,000 and this much on the next $40,000 and this much after that. And they have a good idea of what the tax rates are coming in, or some business owners do anyways. But usually what they forget about is the CPP that they have to pay on top of the tax if they're not yet incorporated. And it's usually about, it's roughly 10% on the first $50,000. So there's an additional $5,000 in CPP that's paid in addition to the tax. And people say, $5,000, that seems like a lot for CPP. But really, when you're self-employed, you have to pay not just the employee portion that you're used to paying when you had a regular T4 job, but you also have to pay the employer portion. And that's a lot of people don't really realize about that is for every dollar you were paying in CPP, your employer was chipping in another dollar on top of it. And when you're self-employed, you're paying both of those dollars, and it works out to about $5,000 every single year.
Wow. So will a corporation help you spread out and reduce tax from higher income years?
Yeah, so one of the benefits of a corporation is you can choose when that money gets brought in as personal income, or if it does even. But when you're proprietor, if you have a big year, you have to pay tax on that big year in that big year. So let's break this down into an example where, let's say you're a lawyer, and you're a lawyer and you have a couple of big cases, and next year you're going to take some time off. Well, now you have to pay tax at this crazy 48% rate when you could have spread that tax out over 2 years and pay, less tax, because, the tax rates go up the more and more money you make. So you can, effectively pay tax on money on this over a couple of years. And we have, some women who are clients, and they go on maternity leave as an unincorporated person. So they pay crazy tax in 1 year and then no tax in the next year. And of course, they're not getting EI because they're self-employed. When they could have used that other year to spread out their tax. They could have paid tax evenly, paid less tax, and took full advantage of the marginal rates, and spread that tax out over time.
So what are some of the secondary benefits of incorporation?
So the secondary benefits of incorporation are number one, it's limited liability. So it's dramatically decreasing your risk of personal liability. It's helping you protect a trade name. It's giving you an avenue to raise funds. You get any business loans. It gives you that element of legitimacy to in the business. So there's a number of these secondary items, and also some people just won't hire you if you're not incorporated. So there's a number of these secondary benefits to incorporation that people should consider, as well as just the dollars and cents.
All right. So if someone is only concerned with tax, when should they look at incorporating?
Yeah, so if they don't care about any of these other secondary benefits, they say, I'm never going to get sued, or I have no assets to guard against anyways. Okay, I guess. But if they're only looking at it from a spreadsheet perspective, usually like $50,000 is like a break-even point for most people. In most circumstances, it can change from circumstance to circumstance. But a lot of people, if you're not incorporated and you're making $50,000 a year in this business, you're probably paying more money to not be incorporated. So instead of sending the extra money to your accountant or lawyer to get the corporation set up, you're sending more than that to the federal government, the provincial government every single year to not be incorporated. So I think that's what we have here today on personal tax rates versus small business tax rates. As always, please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And if you have any comments, we'd love to hear them in the comment section below so we can respond back to you and use your feedback for future videos. Thanks very much.